Welcome to episode 4 of season 2 of the JAIAC's Dispute Management in a New World podcast series. 40 minutes of bi-weekly conversations with Dr. Christopher Malcolm, dispute management practitioner, academician, international legal consultant, entrepreneurial visionary, and Secretary General of the Jamaica International Arbitration Center. And on this episode, our conversations with Dr. Christopher Malcolm is the final of a 2-part discussion on de-risking of banks and bank customers. Dr. Malcolm, welcome again.
Thank you, Nico.
All right, last time we spoke, we covered quite a bit in terms of the issues on the side of banks and their customers. Now, let's talk a little bit about the different categories of bank customers and the different risks that those present.
There are different types of institutions which are commonly considered to be banks.
Mm-hmm.
There are ordinary commercial banks. There are banks which are considered to be merchant banks. There are banks which are institutions which are considered to be investment banks. Mm-hmm. There are institutions which are considered to be development banks. And that is in a very generic sense. But when the average person thinks of banking, you're thinking of commercial banking. And the types of customers that those have will vary, but generally it encompasses everybody in any given society. So you will have banks, they're providing merchant services to other businesses. Mm-hmm. They will provide services to governments as customers. They will provide services to government entities. They will provide services to charitable organizations. They will provide services to institutions. So the range of customers that they provide services to will vary depending on their individual niche and depending on where they function.
So let's talk about some of the risks that each of those may present.
Well, the risks, let us take government, for example. Governments would be considered to be low risk to banks in terms of what happens in terms of the relationship. However, that is a very broad statement because there are some countries that others view as terrorist states and have all sorts of views about them. And so engaging with those customers could, in fact, depending on what it is that you're doing and depending on who you're referring to, be considered high risk. So while they may not, for example, in their own countries, be considered as high risks per se, because the banks in their own countries also have to do correspondent banking relations and in fact have their own banks, banks in those other countries may view them as high risks, and by reference to that, the risk to the bank would be considered high because it could well jeopardize their correspondent and other banking relationships. So there are those factors. Your individual customers, if I were to get to those, again, it depends on the nature of the individual customer. So the average pensioner is not, ordinarily speaking, a high-risk person for money laundering or so on, but you may have, among the individuals, persons who are of questionable character in terms of what they do and what they engage in, and clearly those would present at different types of risks. You would also have, among businesses, different categories of business in terms of what they do. And again, the banks will have to profile those, and some areas are considered more high risk than others. So for example, it is generally considered in the banking sector that businesses engage, for example, in the construction sector at certain levels, and also in used car dealerships and so on, are sometimes considered to be high risk. And high risk, and I'm not speaking here now glibly, I'm speaking about what you will hear coming from compliance practitioners. They're considered high risk for money laundering and considered to be places where it is possible that money laundering happens. Am I saying for 1 minute that persons who are engaged in construction or in used car dealerships and so on are in fact in the business of money laundering? Clearly not. But I'm saying that there is some learning to suggest that there are compliance approaches that treat certain industries and certain activities as themselves being high risk, and those two sectors I just mentioned are in fact among those that are so considered.
But businesses need banks and banks.
Businesses need banks and banks need businesses. Banks need businesses and people to provide money to them, which they can then use to engage in their own business of banking.
So some of those risks are acceptable risks.
Banks, are not in the business of risk avoidance per se. Bankers will tell you that they're in the business of responsible risk management. So you understand the risks and you determine whether you have the appetite for that category of risk or not. But you will never, as a banker, be able to avoid the possibility of risk altogether. It's just not possible.
What are some of the benefits that businesses get from having banking relationships?
One of the things that happens with ordinary business as they grow and develop is that they need ongoing sources of financing. They also need spaces through which they can manage their cash flow, right? In terms of operating accounts from which they can transfer and transact their businesses. So for example, let us use a used car business since I mentioned it earlier. If you're in the used car business, say in Barbados or wherever you are, and you're in the business of purchasing cars from Japan for resale on a local market, clearly you're going to have to engage in your business activities where, among other things, you're transferring money across the miles. It is through the banking system that you're going to be able to have those transactions completed, right? And of course, when you earn monies, you want to have them flow through your bank accounts, and you also will have to make payments to your employees. You also will have to, from time to time, make reimbursements, sometimes even, to customers and so on. You will have to receive payments from customers, and those are conveniently dealt with, either directly or indirectly through the banking system. So there is that obvious need that arises. And of course, from the side of the customer, other customers as well need the banks in an individual sense. A pensioner may need an account into which, let's say a pensioner in Jamaica who is earning a pension from the United Kingdom. Yes. It is unlikely in this day and age that persons are going to be sending checks and so on to you. They send it through a banking service. And that comes through your banking institutions, through a regular wire transfer or some other such transaction. So the system is designed to allow for seamless movement of financial resources across jurisdictions and within jurisdictions.
It's hard to imagine how we even survived without banks back then, in any way.
I mean, banks have always existed. It's just that banks have morphed over time in terms of how pervasive they have become in the value and in the ambit of the services that they provide.
Let's talk about who is a developing economy.
A developing economy is traditionally considered to be an economy with low resources available for internal and low capacity for generating internal wealth and so on. And it is an economy which is working towards transitioning from that stage into another stage of emergence and hopefully at some times becoming what could be considered a developed economy, which is able to provide a good quality of life for all its citizens. Now, in a developing economy, you have a number of factors which are at play. One is because you have low income and resources available. The likelihood of that economy being able to from its own internal resources, fund all its infrastructure and other development activities is quite low. So what the banking system will do, and when we're talking about banking now, we're talking about both domestic and the international banking system, right? So what the domestic banking system will do, it will be there, of course, to continue to provide local services to the individuals that are there, governments, of course, businesses, governments to deal with regular day-to-day transactions and so on. But in addition, you now have a situation where those economies as well will go to the international financial markets to then try to seek funding that will enable them to develop their local infrastructure. With the hope being that as you develop your infrastructure, you create the opportunity for jobs, you create the opportunity for wealth creation and so on, which will then allow your economy to grow and develop and expand, right? And the banking system is critical to this in terms of what it does by way of intermediation and also what it does in terms of providing access to financing, both from the international as well as from the domestic level. And of course, when you're seeking as a developing country to grow and develop, while you're seeking and looking to the external resources, you're also looking to see how you can develop your own internal resources, including your financial sector resources, that can then allow for greater development of the economy, which is of course being assisted by external resources as well.
So in a sense, there is some dependency in a developing economy on developed economies?
Developing economies are typically economies that rely on the financial resources and savings of persons in developed economies to fund their own development. It is also true that a lot of the international financial institutions, the World Bank, the IMF, and so on, their major shareholders and persons who have the greatest impact in how their activities are carried out tend to be the major developed countries that influence, being sitting at the real bargaining table, influence decision making and how things are dealt with that can then have spin-off implications for developing economies.
Let's talk about the US. How does that now relate to developing countries?
Well, the US is in an interesting position in that since the Bretton Woods Agreement back in the 1940s and so on, if we go back that far, long time, we've had a situation where the US dollar has really become, over time, the dominant international currency and the benchmark currency for transactions. So what you find happening is that international trade and transactions related to it tend to be pegged and treated as US dollar transactions. That is changing.
It is.
And we're seeing more and more, especially with the greater emergence of China, we're seeing a situation where there's some level of imbalance happening and things could change over time in ways that we don't understand yet. But what happens there, because the US, effectively the US dollar is the benchmark international currency, in relation to developing economies, it behoves you, and in fact it is critical that you have some relationship with that economy which will allow for your own economic development. Why? Because you have a situation where all international, the major settlement, netting and so on of international financial transactions are done in the US dollar, generally speaking, right? The idea of maintaining good correspondent banking relationships is so important because if it is, that your international trade and investment transactions are effectively pegged, in and out of quotes, to the US dollar, and you do not have a relationship with the US banking system, then you are in a very difficult position. There was a former chair of the Federal Reserve Bank of New York who puts it this way. He then said that I shudder to think of the day when external countries or people in other places other than the US could use the US dollar in such a way as to undermine our own economy, right? So they have a position which they're very clear on. The US dollar is a part of our sovereignty, and they have acted in that way, and you cannot fault them for doing that. Because the truth is, if persons were to abuse the use of the US dollar, which then seeks to undermine its value and undermine its import, then that would necessarily have implications for the US. And you need to bear this in mind as well. But the US, because of the importance in international circles of the US dollar as a benchmark currency, the US is perhaps the only jurisdiction that can go about printing money for use and it not have money inflation the way it would in other countries if they go about printing their own currency. Because people are always buying up US bonds and things related to their treasuries and so on because of the importance of it. And it is because the US does that and they're able to do that, it is important for them to maintain the integrity of their own currency because they know that it is the integrity of their own currency that allows a lot of the influence that they are able to use in the international financial markets. And that is something which requires a lot more consideration. And in fact, it is for that reason why the US would be foolish, I would think, and I'm sure they're not, to find themselves in a position where they do anything at all or allow anyone else to do anything that would undermine the significance of their currency.
Doc, what are some of the current compliance requirements, still in banking? What are some of the current compliance requirements for banking?
The compliance requirements will vary across jurisdictions, but the basic ones that you have, frankly, center around know your customer related to know your data requirements. And what is ordinarily required of banking, wherever you go, is that the regulator wants to know that the banks know who they are dealing with and that they take adequate steps to ensure that the nature of the underlying transactions that their customers engage in are transactions that are legitimate and are not unlikely to be inimical to their own business activities or to the activities of the economy as a whole. So what they will, and in doing that as well, the compliance requirements are geared ordinarily as well to ensuring that the banks maintain what are called good prudential practices. And the prudential practices really are much more accounting in nature, where it's geared to ensuring that the banks are able to operate on a model which allows for the persons, when they require their monies, to be able to get it back. Now, that's a mouthful for this reason, that there is no bank at any given time where if every customer with funds with them were to call on the bank on a given day, they would all be able to get their money back at the same time. The bank would simply go insolvent, plain and simple. So what they do is that there's a model that is applied with an understanding of what they think would be a likely call on any given day, and the banks are required to do that. So the banks, for example, will also be required in the ordinary scheme of things to maintain minimum deposits with their central banks, and those minimum deposits are things which they're not ordinarily able to use, but they are there also with a view to ensuring that there's some prudential protection. In addition to that, there are requirements, in some jurisdictions more heavily enforced than in others, that focus on what we call conduct of business regulation. That is to ensure that the banks deal fairly with their customers, that they engage not looking at more broader systemic issues, but looking at what happens with individual customers and how they treat. Now, I should hasten to add this. The prudential approach to regulation is much more systemic in nature. The approach there is to look to see how is the system functioning as a whole, and what is it doing by way of ensuring that the adequate protections that are necessary are there. Conduct of business regulation, on the other hand, is usually much more individualistic in nature, in that it is looking to see whether or not the basic minimum standards of treatment are being dealt with. My own view, and it's not a view that is popularly held if you look at regulatory models globally, is that if you implement an effective conduct of business regulatory model, which includes as part of that something which has a critical prudential requirement, which could itself be considered conduct of business in nature, right? Then you will cover the whole gamut. But then again, I'm an outlier. I also think dispute management instead of dispute resolution. So I am an outlier in that genuine sense. But I happen to think that the models that we focus on could in fact include more, certainly in our jurisdictions, of a conduct of business approach. Why do I say that? We hear all too often customers complaining of how badly they are treated by financial institutions. And I think we need to relook that if we're concerned genuinely about customer welfare, to ensuring that businesses are conducted by banks in a manner which is respectful of their customers and which ensures that they're properly treated and not simply taken up in this whole systemic approach that is ordinarily adopted.
I'm operating a business and I need some funding to kind of take it to another level.
Yes.
What are some of the critical thinking approaches that I need to start taking now when looking for that funding? When I'm approaching an investor, what should I be thinking? What should I be concerned with?
So your first obligation, quite frankly, in a very general sense, is to start thinking of what do I need to do to ensure that I develop what would be considered a bankable project, so that when I take it to a bank to seek financing by reference to it, the bank will say, well, we see here that you have carefully thought out what the inputs are likely to be, what the cost implications are, how it is that you're going to be able to ensure cost recovery and those sorts of things. And by reference to this project, by basis of how it is thought, by basis of the way the financials and so on have been computed, expectations, of course, we are seeing in this something that we are prepared to associate with. There are other things you want to bear in mind as well. Banks are increasingly as well concerned about things like green projects, which are climate smart projects. You want to ensure as well, when you're thinking of bankability, there are a number of factors that you want to take to the table. Remember, banks operate on the basis of risk, right? So banks will want to look, when you're coming to a bank with a project, they are going to assess that project by reference to risks. And what are some of the typical risks that any project could be susceptible to? A significant one is political risk. Is the project being carried out in a jurisdiction where the government is unstable, or the government is likely to become unstable, and where the regulatory approach adopted by the government and currency-related approach is likely to change on a whim or a fancy? That's a factor to be considered. And I'm not suggesting that in our own jurisdictions we have that, but it certainly is a factor to be considered. Remember, you're going to the bank, you know. So you want to think of what is it that the bank could have in its own mind that I must therefore ensure that when I take my project there, they are likely to say you have given thought to the things that we have in mind and you have answered those questions appropriately. The bank will also want to ensure that beyond political risk, you're looking at basic economic risk. Is the project one which is likely to be viable? Is it project one where a product, for example, will be produced and there will be sufficient off-take persons to buy the product? That is something which is going to have to be mapped out properly. Supply-demand issues and so on come into play. You're going to look at other issues, including, for example, environmental risk. Are you thinking of a project of building something on a seashore that is already being eroded and will be eroded by the time the project starts being built? Environmental and related risks, climatic condition change and so on. Those are risks that are there. Are you thinking of a project which, when you look at it, there is a time-sensitive risk to it, in that it may have been a good project yesterday but will not be good tomorrow? Are those issues there and properly considered? Then, for me, as a dispute management practitioner, and there are several others we could think of along that line, but I'm going to want to think as well of, are the issues relating to dispute management properly considered? And why do I get to that level? I get to the level because it is true that there are instances, far too many, where there are projects or institutions or entities that could go insolvent, not for want of money, but because proper legal arrangements are not in place, including in relation to how disputes are to be resolved. And a bad dispute, not properly dealt with, could erode a good project. So you want to ensure that you think of conflicts that are likely to develop, understand what the risks related to that are. So getting back to where I started as well earlier, when I indicated in a previous episode that you have to go with that idea of risk management. And my risk management, 3 letters, I live by them. I am that I am. I for identification of risk, A for proper allocation of risk, and M for proper management or mediation of that risk. And if you take that basic framework and then start fleshing things into it by reference to things that are important or considered to be important to a bank, then you are always likely to determine very early whether you have a bankable project or not. Because bear no bones about it, the bank is going to take a risk-responsible approach to any project before they, in a very mature and considered way, make a decision to invest or to provide financing for it.
What about if I'm a business operator and I'm approached by someone who wants to invest in my business? What are some of the considerations that I need to give before accepting that investment?
If you are approached by someone with a view to your investing in their business, you too should take a risk-responsible approach of determining whether or not you're going to get a return on your investment. There is no point in investing money in anybody's business. In fact, there's no point in investing money in your own business unless you can be satisfied that there is going to be some reasonable return that you can get on that investment. If not, you could use your money to do other things. So the same sets of considerations that a bank would take, as in trying to understand whether there are any political, ecological, environmental, dispute management, or other risks that could undermine the project and therefore negatively impair or impact your capacity to recover your investment and a reasonable return on it, is the same approach that you're going to take.
What role do policymakers play in assisting banks and customers in terms of their customer de-risking?
A significant obligation of any government is to create an enabling environment for businesses and an enabling environment in which their citizens can realize their life goals and their objectives, right? Mm-hmm. That's a significant obligation of any government. Now, if the government functions in an environment where, or the state is in a position where de-risking is a real possibility, then it is for the government to ensure that adequate measures are taken to reduce the possibility of those things arising that could ultimately lead to de-risking. So let us, in the context of, say, Jamaica, think of lottery scamming and how it is that that can negatively impact businesses and de-risking and lead to de-risking. Lottery scamming has its genesis in what is clear criminal activity. But in addition to that, lottery scamming really comes about in circumstances where there could well be considered to be insufficient possibility for economic expansion and therefore absorption of persons who are bright and able to play with computers and play with people in order to earn money from them in what would be considered criminal by reference to criminal activities. I mean, we can sugarcoat it as much as we want. What they do is criminal activity. So what you want then to find is a space in which government programs and activities are able, where possible, to reduce the possibility of persons being caught out where they're simply sitting on a street corner doing nothing. The devil makes work for idle hands. So you want to reduce the number of idle hands that are available. You also want to create a situation where those bright young persons, there's nobody doing lottery scamming who is able to go through all of what they go through, who does not have some inherent intellectual capacity and skills that allow them to do that. So the question is, how can those skills and capacities be redirected and some good opportunities found for them that will then take them away from lottery scamming into more and other productive activities? And of course, once you get there, you have to also think of productive activity which is at a level and a standard which will make people comfortable, because the truth is, if persons find themselves in circumstances where they are unable to take care of themselves at the level they want because the economy does not allow for that to happen, then you are going to find that they, notwithstanding the best of opportunities that you think you're providing, they're going to move away from that to other activities that they think will allow them to do what they want to do. So government, therefore, if we're getting back to this, has to have that overriding obligation and try to carry it out. And it's a difficult job. I don't begrudge any government member or any government anywhere that is trying to do that. But you must at all times try to develop and implement policies that are able to reduce idle hands and that are able to ensure that people are able to come into legitimate income that can allow them to sustain a decent life without having to resort to criminal activity.
Talk to us a little bit about some of who those persons are who are responsible for whether compliance or de-risking within banks.
You typically have a bank structure which ordinarily will include compliance risk officers. And they come as, what you call them in terms of title will vary from institution to institution. But they effectively are gatekeepers, and the traditional position, and in fact the position that you expect to find, is one where your compliance persons have direct reporting obligations to their boards of management, to the board of governors of the institutions in which they're involved. So while they're a critical part of management, and while they're a critical part of operations, they also must be above operations in the sense that their compliance function should be designed in such a way that they're able to report upon things they see within their own institutions without feeling a sense that they have to go through the very people that they're reporting upon, right? So that is why in a typical and well conceptualized structure, you would have a compliance function with a reporting obligation to the board rather than through management.
Interesting. What about those responsible for de-risking? Are those the same person?
The de-risking persons, typically it's a compliance function, because it's a compliance persons who will, on a day-to-day basis, a compliance function, it will include typically multiple persons, right? Mm-hmm. Who will be there to be looking at all transactions. So for example, when you seek to open a bank account, and that is why sometimes it takes a little longer than simply a single day, because what will happen is that once the documents are filled out, it is the compliance persons who will now carry out effective due diligence to determine, one, whether the information provided is credible, and whether or not the nature of what it is that the intending customer is purporting to get into is something that the bank has an appetite for. And the compliance persons will then make their report and will make their recommendations as to whether or not this is a customer that should be taken on or not. So the compliance persons have multiple functions, including in relation, because as I said, they're effective gatekeepers. Mm-hmm. They're gatekeepers as to who comes into the institution. They are also the persons who will, from time to time, make recommendations for de-risking, meaning termination of accounts. Mm-hmm. And they're also the persons who have a critical function relating to, by going to the board, to identify operational and other risks in the institution that could put it at the danger of being itself de-risked.
Digital banking.
Yes.
That has taken a new presence over the last couple of years, especially here in Jamaica. We have a number of banks who have gone full-fledged into digital banking. What are some of the benefits to that from digital banking to customer and bank?
The banks that are moving away from traditional and into more digital, into digital space, but you have jurisdictions which are going even further to the point of trying to get rid of cash altogether. China, for example, is well down the wicket in terms of moving to a space where cash will become a thing of the past. And it's interesting and instructive to note that while China is going there, we need to remember that it was China that invented cash in banking anyway. So they are effectively seeking to replace what they in fact invented, in a sense. But what we have to think about there, as you asked about the benefits, once you're online and digital, it is the ease of doing business and transactions can become much easier because you have a footprint which will include the critical information required and makes it much easier, it would be thought, for compliance and due diligence to be conducted, right? So that's there. But it is also true that the moment you create a digital footprint, it is also one of those things where if that footprint is interrupted in a critical way, and you know your hackers and other people getting into it, that creates its own sets of nightmares. And we know people who are trying to recover their identities, for example, because people have stolen them.
Yes, yes.
And we know persons who it is not difficult in the context of digital space for persons to create all sorts of stories that don't really exist. So the digital space has its many benefits, including for efficiencies, including for speed of doing business and so on, but it also has its detriments, and it's a space where once the banks get into it, they need also to be very careful that they put in place sufficient measures for management. And of course, there are a number of other issues, including in relation to dispute management, which we could speak about, that could also come out of the digital space that the banks are getting into.
Let's go back a little bit to the landmark Orleans National Commercial Bank case. Even though there's a need to have a banking relationship, there is also a right on both sides to decide whether or not they should do businesses together, right?
Yes.
How is this significant, and can effective dispute management assist here if problems arise?
Well, dispute management is always able to assist, but let us think about it. Remember I said that banking includes a number of underlying contracts operating all at once, yes? So when you as a customer enter into or seek to enter into a relationship with a bank, you are doing so on the basis of a contractual relationship. Now, the very essence of a contract is that it must be a voluntary relationship. You can't force somebody into a contract. If you force them into it, then you have taken away the voluntary nature of consent.
Yes.
Because an agreement, for it to be a valid agreement recognized by law, must be one where it is shown that it was not entered by duress or any other such thing that could undermine free will and consent. You have a fundamental freedom to contract, but that fundamental freedom to contract includes your being able to establish that there was a consensus ad idem, or a meeting of the minds, and that meeting of the minds is one which is premised on the basis that it must be genuine and not forced. But the bank also has an obligation to ensure that it is not introducing to itself a relationship which is toxic and which could undermine its very existence. So it is a relationship which requires frankness, fairness, and integrity on both sides.
Before we go, here's today's Did You Know fact. Did you know that you can visit the JAIAC's website at www.jaiac.org to find out more about their services in arbitration, mediation, mutual evaluation, and adjudication, and their other services in alternative dispute resolution. Until then, I'm Anika Nelson, on behalf of Dr. Christopher Malcolm, Secretary General of the JAIAC, saying thank you for joining us. Now that's where we wrap things up for today's episode. Please remember to tune in to each of our bi-weekly Dispute Management in a New World podcast episodes available on Buzzsprout, Podbean, Spreaker, and the JAIAC's YouTube channel. It's sponsored by the JDIC, protecting deposits for you and me.
I save because one day my little business is going to be a big deal.
Yeah, and I make sure to put away a little something for him.
And thanks to JDIC, deposit insurance protection on my savings gone up.
You've been upgraded. Deposits held in commercial banks, building societies, and merchant banks are covered under the JDIC deposit insurance scheme up to $1.2 million per depositor per institution. JDIC.
Protecting deposits for you and me.
I'm your host, Anika, saying on behalf of Dr. Christopher Malcolm, thank you for joining us. Special thanks to ADEB Consultants, consulting engineers in the Caribbean for over 57 years. Regis, Work Your Way, Caribbean Institute of Alternative Dispute Resolution, Wassel & Wassel Arbitrator Services Incorporation, iNeutral Dispute Resolution Made Easy, CP Malcolm Dispute Management Practitioner, and Impact Justice, improved access to justice in the Caribbean.
The way we do business has changed. Don't be left behind. Choose a hybrid solution for your workforce. Regis offers furnished, equipped, ready-to-use office space available for days, months, or years. Our fully serviced private office spaces give teams of all sizes an inspiring environment to focus, collaborate, and do their best work. The world is switching to hassle-free hybrid working. Join the revolution. Switch to Regis. Call 876-618-8800 or visit regis.com.jm. That's regus.com.jm.
All our episodes are also distributed on Google Podcasts, Spotify, Apple Podcasts, Amazon Music, Deezer, Stitcher, Podcast Index, Pandora, TuneIn Plus Alexa, Podchaser, Podcast Addict, and wherever else you get your favorite podcasts.